Welcome to the show, Money in the Morning. I hate when I do that. Oh, snafu, Natalie, right? Welcome to the show. Be the boss of your money. It's about personal finance, investing, and all those important money questions that you may have. If you do have questions while you're watching this, either in the live stream or if you're catching this in the replay, please ask me in the comments below. If you don't mind giving us a thumbs up, it helps the cause, helps other people see the work we're doing, helps your contacts see this as well. So the themes today is Salesforce gets smashed during aftermarket trading. That's a big tech stock, an important tech stock, and this is not a good thing. It's tech. Salesforce is big enough to have an impact on the rest of the market and the rest of the tech stocks. So Abercrombie and Fitch and Dick's Sporting Goods both had really solid earnings announcements. So consumers are spending like crazy. But then Target announces they're lowering prices on some thousands of things. So does Walmart and so does Walgreens. And it's evident that the consumer is stretched. So who's spending where? Teens are spending. That's Abercrombie and Fitch. People who like to spend on high-end athletic equipment, they're going to Dick's for their stuff. That is good, but it's a bifurcated market. That's why I say teens are spending, but the parents are not. Let's get into it, and I will be right back after this intro. So stick around. Here we go. All right. Thank you so much for joining me today. It's Mitch Goldberg, and you're watching today after another tough day in the market. Let's just go to the share screen right now. Dow is down yesterday, down 400 today. It had a down 600-point day last Thursday. Yesterday, I think it was down, about 200 some odd points, today 400. What we've been talking about the last couple of days is things are looking shaky. We hit that Dow 40,000 mark. It's a common thing to pull back from a fresh new high. I don't want to say that this is the end of the bull run. We've had this nice rally going on that's moved the Dow Jones up. The NASDAQ hit a new all-time high yesterday, breaking 1,700 for the first time. These are important, but yesterday, really, the NASDAQ was just lifted on the heels of one major company, which was NVIDIA. It's not just NVIDIA. The other big tech stocks had an okay day, so nobody was able to take away from NVIDIA's huge day. But NVIDIA is a big company, and it's done pretty well. It's done more than pretty well. It's done pretty freaking amazingly well. However, it does seem like, and I said this yesterday, like there's a blow off top. It's just, where is all this money coming from? It's just going into NVIDIA, to tech stocks. This isn't a bearish call, but this is me saying my own thought process of the things that I look at in the market. I'm using my hands here. The things that I look at in the market. It makes me feel like things are a little toppy. That's just me. Now, if a new client comes in today, for example, and they come in, they say, I've got cash to invest. Would it change the stocks that I'm buying for them? A little bit, yeah, because there are some stocks in the last few months that have come down to levels where, I would want to buy them. But by far, generally, though, the stocks that I bought for clients a year ago, I'd still like today. If you want to know what those stocks are, you're going to have to call me. I really don't want to get into individual stock picks and buys and sells on the live stream. But what I tell you, so you could say, excuse me. So you could say, why are you bringing up NVIDIA? Well, it's not so much NVIDIA, but it's an example of a stock that goes parabolic, just straight up. And that concerns me more than anything else with a stock that's up. I don't want to be like, oh, you're such a curmudgeon, you're so pessimistic. A stock is up. It doesn't mean it's a bubble. Not every time the market goes up, it means we're in a bubble. Most of the time the market is up because that's what the market has generally done for all of its history. with some hiccups along the way. But generally speaking, markets go up, and we are right now trading right at or near fresh all-time highs, in spite of the down 400-point day today. But one of the things that I look at is not just upward movement of a stock, but the speed. We talked about this yesterday, the speed at which a stock goes up. That brings me a little bit more concern than just a stock that's going up. I like better slow and steady, but when a stock does have a rocket ship right higher, let me step back again. That's how stocks move. It's like a stair step. A stock could be flat for 9 months, but the last month, on the 10th month, the stock could go up 20%, and there's your return for the year. So that often happens. But with the way that certain stocks move when they go parabolic, it makes me want to consider taking something off the table. It also means that stock has probably become a much bigger portion of somebody's portfolio, and that more or less makes me want to take a little off the table. Every situation is different, though, and it's not going to be the same exact story for every account. We manage accounts on an individual basis. We're not looking to just run one portfolio. Everybody's different, and we approach everybody's portfolio like that. Okay, so you take a look at the screen. Let me pop myself up here. And Dow down 411, NASDAQ down 99, S&P down 39. These are like huge numbers. Okay, so the Dow is down a little over 1%. When you're talking about an index, 39,000, 1% is 390 points. But generally speaking, it doesn't get me overly crazed. This is normal movements, normal volatility, and it's still a pretty good year for the major averages. By the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. We take a look at gold off about 20. Gold has been coming in pretty good too. Oil below $80 a barrel, but it's been trading between 77 and 82 pretty consistently. We really would need to see oil get down to like the high 60s before we could start to breathe a sigh of relief to expect gasoline prices to really come down. What it tells you is after the skirmish between Israel and Iran, when they lobbed a bunch of bombs at each other, 300 actually for Israel and a few at Israel and just a few at Iran. Regardless, they step back, and we come to the conclusion that we already had, that you and I talk about on the show here. The world is supplied amply with oil. Everybody who wants oil, every country that wants oil is getting it. The source of everyone's oil has changed, for example, but we do have plenty of oil in the world. A quick note about the Strategic Petroleum Reserve, the SPR. This has become let me fix my glasses, okay? A quick note about the SPR, the Strategic Petroleum Reserve. This is often a gift to consumers when oil is released. It's also taken as a sign of politics. It's become very political, the SPR. But I want you to think of it this way. We developed an SPR in the 1970s when we were importing a lot more oil than we were able to produce. We weren't able to meet our own energy needs, so we imported oil. And then we had the oil embargo of 72, 73. I think it was 72. The point is, you could just cut that part out. The oil embargo of the early 70s, okay? And what followed was the creation of the Strategic Petroleum Reserve. So if supplies are cut off, or if we're in a time of war, we would be amply supplied by oil. We were producing during that time maybe 4 million barrels of oil a day. We're 12 or 13 million barrels. We produce as a nation more energy than we need. We actually produce a surplus, and we have plenty more in the ground from where that came from. The point is we don't really need a large SPR anymore. It's the people's oil. It's ours. And why shouldn't we have it? So that's my thought on releasing energy from the SPR. It's just not something we really need anymore. it's not really a strategic goal anymore, but it does cost a lot of money to maintain it. And if we have our own oil and we don't really need it, then why, it's just, I feel like people are hanging on to the strategic petroleum reserve just for old time's sake because they're used to it being something important. But times have changed. Our energy production has soared, and it's just no longer important to keep such a large SPR. I question if we even need to keep any strategic petroleum reserve. Private oil companies are able to store and keep their own oil when it's needed in the market, and there are ample supplies. So that's my thought on that. And I could see with a little peace in the world, it could happen that oil could easily fall back down to the 50s, maybe 40s per barrel. We were there not too long ago. And if you recall, just a few years ago during the during the COVID pandemic, oil was actually negative. It was below zero per barrel. So let's move on. The 10-year yield is up to about 4.6, and that's been a pretty big move. It was recently down to the 4.3s. Interest rates are moving up. The VIX is moving up. I don't have to show you all those right now. And, like I said yesterday, we're looking a little, what's the word? Climactic, anticlimactic, a little toppy, a little choppy here. And, if you, and my advice, my recommendation, well, I can't really give that kind of, is it okay if I say the word advice or recommendation? I don't think so. So scratch those two words. If you haven't rebalanced your portfolio for a while and your portfolio is out of whack because the stock market went up, or because you may have a few very big stock moves, stock winners in your portfolio, you should, in my opinion, rebalance your account, and the sooner, the better. Am I making sense to you? It's what we spoke about yesterday. Let's take a look at a couple of other things. Dick's Sporting Goods was up almost 16% today, up $31 a share. And Skechers yesterday hit a new all-time high. And Abercrombie and Fitch, where are you? Let's just see if I get a quote on that. Abercrombie and Fitch. Let's see. Is it coming up? ANF. Here we go. 52-week high. It's up $37 a share, up almost 25% today. These are really big moves. And there's a shoe company, On, right? For On. That's been doing very well. Deckers has just, I think it's $1,000 plus stock now. And it's hard to believe, but the market leaders today are now footwear companies. I mean, these are on a run. Okay, I don't know if you heard that sound effect, but they are on a run for sure. So people are spending on what we would call non-staples more than they're spending on the staples, or their motivation is to still spend a lot of money on the more frivolous side of things. And that's what the teens are doing. And that's why I said teens are spending, but their parents are not. Salesforce.com is getting absolutely crushed in aftermarket trading. It's down about 17%. This is a shame because it took so long for this stock to finally work and become a winner. It was a winner, but then the last couple of years, it just sat around, the stock doing very little. And in the last year and a half, it's finally gone up a lot, and it just got crushed down to $50. This is the CEO, Mark Benioff of Salesforce.com, and he's doing his best Jack Nicholson. Is it Jack Nicholson, the actor, or the golfer? I think Jack Nicholson, right? Looks like he's doing his best tryouts for the upcoming reinvention of the movie The Shining or something. It's kind of freaky. All right. So that happens. But a couple weeks ago, Meta, which used to be called Facebook, took it on the chin, and that stock is recovering pretty nicely. So maybe this one will too. And their thing is they're going to be investing a lot in artificial intelligence, and everyone who uses Slack, which is owned by Salesforce.com, and everyone who uses Salesforce.com, everyone's going to have access now in their contact relations management, in their CRMs, to artificial intelligence. So they are investing where they think they need to invest. And, But the thing is, it's Salesforce has been recognized as an AI play, and the stock just got hit. It just seems a lot of stocks are getting hit. And when you see a Dick's Sporting Goods or an Abercrombie and Fitch go up a lot in a day, that's great. But their market caps are so small and they're such a little part of the overall stock market that they're not nearly up enough or big enough to have any meaningful impact on the overall direction of the stock market. You're still beholden to the top 10 biggest companies, of which 8 of them are technology companies. Berkshire Hathaway is one of the biggest ones. And what's another one? Maybe it's Eli Lilly. So those are of the top 8 companies in the S&P 500. Those are the only 2 that are not technology. That's it for the show today, and we'll see what tomorrow brings. We have a whole new earnings season coming out in about 2 weeks. So we get to go through all of this again and see what companies are saying about consumer spending, and that'll be a big, big tell. All right, guys, have a good night. Thanks for your time.